And so doing a shorter term can save you a ton of money in interest payments over the years. If you can, I would say get as short a term as you possibly can. Please keep in mind that payments change. They never go down. Hi, it's Damien Gutierrez, Damien Gutierrez Associates Realtors, brokered by Real. Today we're going to talk about what's really in your mortgage payment, like what comprises that number. A lot of you might be looking at and thinking principal and interest is your monthly mortgage payment, and unfortunately it is not. We're going to break that down in this video. A monthly mortgage payment has what's called PITI, which is principal, interest, taxes, and insurance may come in two forms. Understanding your PITI, principal, interest, taxes, and insurance, will help you do your budget a lot better than just doing your principal and interest. Keep in mind, if you go on a mortgage calculator, if you go on a calculator and calculate mortgage interest, or if you look on some apps, Zillow, Realtors.com, something like that, your principal and interest may be all they calculate. They might not calculate taxes and insurance, and your payment, your real payment, will differ greatly. So the first portion, tip number one, is principal. Principal is going to be the part of the loan that when you pay your payment, not counting your taxes, not counting your interest, not counting your insurance, principal is the part that gets paid down. So unfortunately, it doesn't get paid down nearly as rapidly as you think. If you have $1,000 payment, $1,000 does not come off your principal every month. In the beginning, you could only have a couple $100 come off. In the end, you have a lot more come off. But principal is the part that reduces every single month. A little bit every single month comes off principal when you make your payment. The largest portion of your payment goes to your interest, and it's because it's a 30-year or 20-year loan. The longer the loan, the more portion goes to interest in the beginning. And of course, the interest depends on your credit score, your asset, and what it is you're buying. So it depends on your loan program. Credit, assets would depend on what your interest is, which would depend on how much of that payment goes to interest and how much goes to principal. So that's a great segue to go into number two, which would be interest. What is interest? Interest is the fee or the charge that the lender uses for you using their money. And so it's based on a couple things. It's based on prime, which is what the Fed set the rate at. It's based on your credit score. It's based on your assets. It's based on the loan that you get. So the interest is the fee you pay for using someone else's money. Third would be property taxes. Nobody likes it. Nobody loves it. Everybody hates it. It is what it is, property taxes. And so the taxes are set by the locality of which the house is located. So if you ask me what property tax is, it's a combination of a tax on the land and the improvement. The improvement would be the house, garage, pools, sometimes decks, sidewalks, driveways, anything improved on the house and the land. They put those two together and they tax you on the whole. And those taxes in Virginia, they go to the schools. I don't know what they do in other locations, but in Virginia, those property taxes go to the school systems. In our area, one thing to think about is in Botetourt County, Franklin County, Bedford County, the taxes are much less than they are in Salem, Roanoke, and Benton. So if you're looking at payments and you're very payment conscious and you're looking at Roanoke, Salem, and Benton, and you're looking at Bedford, Botetourt, or Franklin County, you could have taxes that are $100 to $200 a month less in those locations, which means you could afford more house in those locations than you could in the town of Benton, city of Roanoke, county of Roanoke, or city of Salem. Fourth would be insurance. And there's two types of insurance. We'll talk about both of them. So insurance is going to protect you and it's going to protect the lender. It's required on the loan. The lender requires insurance. If you don't have insurance, the insurance company will notify the lender, and the lender will get their own insurance policy on the property, and it will be much more expensive than your insurance policy. Usually it's paid monthly. What will happen is the lender collects, when they close on the loan, they collect escrows, and those escrows will be 1 year up front plus 3 months, and they have that 3 months as a buffer, and they add it to your payment. It comes out, and then anytime your insurance goes up, you'll get a letter in the mail. Your payment will go up a little bit for that every single time. But it's collected by the lender and paid by the lender, and they do that to make sure that it gets paid so that you don't forget to pay it or it lapses and there's an accident or a fire or whatnot and it's not covered. The second type of insurance is a really ugly one. It's called PMI, private mortgage insurance. Anytime you put less than 20% down on the mortgage, if you do an FHA loan, it stays on forever, even when you have 20% equity. If you do a conventional or USDA, it comes off after you get 20% equity. You have to get an appraisal to prove that. Appraisal has to be done by the bank, not by you, but you have 80% loan, 20% equity, then it can come off. But PMI is private mortgage insurance. And that's because when people have less than 20% down on a house, they have a higher risk of defaulting on the loan. And so it's insurance against you defaulting on the loan to protect the lender. So other things to think about is, the difference between a 15, 20, and 30-year mortgage is usually a couple $100. It's not a huge amount. If you can swing it, a 15-year mortgage will save you, depending on the loan amount, $50, $100, $150, $200,000 in interest. And so doing a shorter term can save you a ton of money in interest payments over the years. If you can, I would say get as shorter term as you possibly can, or get a 30-year and then pay as much extra as you can every month so that you can whittle it down. The interest on a house, if you look at it on an amortization calculator, is exorbitant over the years. So the quicker you can pay that off, the shorter term you can do, the better off you're going to be as an individual. Please keep in mind that payments change. They never go down. They only go up. And they go up because taxes and insurance go up. So as taxes and insurance go up, your payment goes up. And I say they never go down, but if you have a loan, a conventional loan, USDA loan that has mortgage insurance premium, once you have 20% equity in the house, get an appraisal done through the lending institution, that will come off. So the mortgage insurance premium will come off after you have 20% equity. But outside of that, your payment will go up a little bit every year because taxes go up every year. They do. And so does your insurance cost. Quick tips when you're looking at getting a mortgage. First, get a complete breakdown from the lender. Ask them for a complete breakdown. Exactly what is it going to cost me for monthly payment? Not a roundabout. Give me an exact. 2, use a mortgage calculator. I actually like one that's free. It's online. It's bankrate.com. And don't get your loan there, but I really do it is my go-to. It has been for years for mortgage calculator because I can put my taxes in there, I can put my interest in there, I can put my down payment in there, and it'll kick out, it'll give me amortization schedule. I really like bankrate.com. Not an ad for them. I just use them. I've never paid them a penny. I just use them. 3 would be don't focus just on interest rate. Look at monthly payment. What can you afford? And then lastly, build in room for if you're so tight on budget you can't afford for insurance to increase or taxes to increase, don't buy the house. Have enough room in your budget that when those things increase, you can accommodate those things because they will increase. If you like this video, please like and subscribe. If you had any questions, please comment below. Please visit us on Facebook at Real Estate Success Cast. Until next time, bye.